Republican Randy Neugebauer. He's also a member of the House Financial Services Committee. And Scott Talbot, he is the Senior Vice President of the Financial Services Roundtable. Scott Talbot, beg your pardon there before. What are your thoughts about these new regulations, this new reform in financial services? Does it go far enough?
Yeah, I think it goes far enough, and in some cases even goes too far. We think there is need for reform. There is need for a systemic risk regulator. We do think the Fed is the right body to do it. We are pleased with the president's proposals on insurance, but it could go further there. But on terms of consumer protection, we're for strengthening the protection of consumers, but we think creating a whole new agency out of whole cloth that will separate the regulation of the bank from the regulation of the products goes too far and is unnecessary.
Congressman Neugebauer, can you speak to the issue of Congress and lobbying? Would it make sense to have some kind of voluntary ban on lobbying from the financial services industry until at least you were able to figure out what kind of reform we really need?
Well, I think that's a question that probably needs some discussion. You know, I think by and large, I don't think most members of Congress are going to be influenced in this process by the lobbying efforts. What we do need, though, I think is important to make sure that everyone is at the table, because it's important to get this right. And for the Congress to try to separate itself totally from getting input from the people that we're going to ask to implement many of these laws and regulations, I don't think is a good process. What I do think we need to do, though, is make sure we get this right and not be in a rush to just to say we got some kind of a financial product here, because we are talking about revolutionizing regulation for financial institutions, and they're an important part of our economy, important part of attracting capital. And if we don't do this right, then I think we do a disservice to the American people.
Congressman, are we going to see restrictions placed on leverage and the amount of risk that firms are allowed to take?
Well, I tell you what, capital is one of the best regulators tools that you have. And when people are taking riskier bets, then they should have more capital to cushion that. And so one of the things about our plan is that we actually form a financial stability and capital adequacy group, which is consisted of the regulators themselves. They can look into the marketplace, determine where there are areas where there could be some systemic risk building up, and rather than designating those entities as a systemic risk, just increase the capital requirements, and that begins to regulate a lot of that behavior.
Let me come to you, Scott Talbot. Do you think that the risk and leverage need to be regulated? How can you be sure that companies in the financial services industry are not risking too much?
Well, I think you take a look at the products and the positions that the companies take, and then I agree with the Congressman that you need to set aside capital limits or set aside additional capital and liquidity ratios to make sure that the institution is protected should those positions go south and threaten the entire institution or the economy itself. So the capital is definitely a way to go to help strengthen the institution and protect against those risks.
So, Scott Talbot, do you support complete transparency for all in the derivatives market?
No, we do not. We don't have a problem with regulating pure vanilla OTC, pure vanilla contracts that have a price discovery mechanism that occur routinely and are beneficial to the market. What we oppose is putting every single private contract, running it through an exchange or a clearinghouse. That would be overkill and could actually end up hurting those markets. We don't mind having them be reported, but we don't necessarily need to run through a clearinghouse or an exchange.
How would that be detrimental to the industry, Mr. Talbot?
It could have a limiting effect or a chilling effect on the willingness of parties to enter into those types of contracts, which are specific to those two parties, which could hurt risk and not let them manage risk properly if they're worried about someone looking over their shoulder or additional capital requirements. If there's no price discovery mechanism and the product and the contract is simply between two parties for their own particular risks, there's no need to run it out through the entire exchange.
Congressman Neugebauer, do you agree? Do you think that there should be some limits on transparency, or are you for complete transparency when it comes to the more exotic derivatives in the marketplace?
Well, I like clearing the standard contracts. I think that makes sense. I think the industry, by and large, supports that. I think there are some proprietary arrangements that companies that enter into that necessarily shouldn't be made public. You know, if they get to be a large systemic risk, then possibly you may want to look into that. But quite honestly, in many cases, many of those contracts weren't really a part of how we got in this situation. But certainly clearing many of those transactions, I think that makes sense. That brings quite a bit of transparency to the marketplace. A very small number, volume of these private transactions are really out there in the marketplace. The big volume is really in more standard contracts.
Congressman, how do you ensure that companies have skin in the game when they're, let's say, securitizing whole batches of assets? If they're just going to sell them on, they don't have a lot of stake in what happens afterwards. Does there need to be a change?
Well, I think what's going to happen now is I think people are going to start looking at these transactions much more aggressively than they did in the past. I think in the past they were relying on the credit rating agencies to do all of their due diligence, and I think any kind of securitized market moving forward will have a lot more scrutiny, and that is something that the people that are buying those and people that are selling them are going to have to look into, is how to make sure that there's enough transparency in those transactions. If it takes skin in the game to actually market those securities, then the marketplace will demand that. Some people maybe will have to put skin in the game, some won't. But I'm a little concerned about mandating certain capital requirements and risk retention standards by the government. I think the marketplace may better be able to determine that.
Scott Talbot, last question. Do you agree? Do you think that companies ought to have skin in the game for the securitized products that they create?
We're not opposed to the concept of risk retention, but we think a flat 5% a flat 5% as proposed by the president today is too inflexible and goes too far. We think if you're going to have a risk retention standard, that the federal regulators should be able to tailor that to the individual product and the institution and make the judgment call on a case-by-case basis rather than a flat 5%. And the House of Representatives is already moving in that direction, the flexibility, and so we're in favor of that.
All right, I want to thank you very much, Scott Talbot, coming to us from the Financial Services Roundtable, and Republican Congressman Randy Neugebauer. Coming up, our next